Well, hello, everybody. Well, happy Tuesday. Welcome to the webinar. We are broadcasting, I say we, not we. He, Don Rasmussen, is broadcasting live from Jamaica. Be jealous? I sure am. Excuse me. I'm under the weather with a cold and a sinus infection, and that is all that it is. Rest easy. So I'm super excited to have Don here. He's like our go-to tax expert to tell us everything that you need to know as business owners and what to expect with tax changes in 2022. He has been a frequent guest of the webinar series, helping us get through everything from PPP loans, educating us on tax credits, and everything to help really, loosen that burden of taxes on your bottom line. And we are so excited to have you here today, Don, especially since, again, you're taking time away from your fun in the sun in Jamaica to be here with our attendees today. So thank you so much.
Thank you, Christy. Yeah, I want to clarify, as I told her earlier, this is a tax conference. I guess they have to tempt us with coming to Jamaica to be able to get us to come listen 2 hours of about taxes. So anyways, let me change my screen over here.
I don't know about y'all, but I'd go to a tax conference if I could go to Jamaica.
Yeah. Well, there's pain and pleasure that comes with it. So what did I do here? There we go. Let's try it one more time. All right. Now we'll try it one more time. All right. Yeah. It's sometimes you just got to do what you got to do. But we're going to be talking about that today. Do you see the Build Back Better?
Yes, sir.
Okay, awesome. So, as I was telling Christy, when we announced the topic, the Build Back Better America was a tax proposal that was made. And in December, Senator Manchin from West Virginia put the hiatus or kibosh on it, specifically, and I'll talk further about this, about the child tax credit, which is a sticking point. So I'm going to lay out to you from a business and a personal basis how this proposed tax law is going to impact you. I'm going to talk about, first of all, Mr. Biden's proposals with the Ways and Means Committee, and then the House, which that's where it's left off lately, is the House, and they've sent it to the Senate to get their approval or denial on things. So that's kind of where things stand. And then once I complete that, I'm going to talk about how you can still reduce your taxes and get some tax refunds back, even though we don't have any law in place. Now, we do expect that there's going to be some conversation about these. Actually, I was just reading yesterday, and they were talking about this here at the conference of some things moving along in Washington. We'll see. Nothing's for certain except death and taxes. So today's webinar, I'm going to talk about two things specifically: is the Build Back Better. And then, of course, secondly, best things you can do for 2022 and even 2021. So I'll talk a little bit about what those things look like. So let's first of all, everything that you see here in the yellow is going to be more impactful to you as a chiropractor. I'll just say that right up front. This is the business. I will look at the personal in a second. One of the big proposals that President Biden brought was to increase the corporate tax rate to 28%. It was going to raise $857 billion in revenue. The Ways and Means Committee came out with a 26.5%, which would have raised $540 billion. And then the House came with a revised of leaving it at 21%. And so that's where it stands right now, is at 21%. There's going to be zero revenue that's going to be created by leaving as it is, or increased revenue. Let me rephrase that. The one further down here is the further limit interest deductions. And this is going to be the ability to limit how much you can deduct from your practices from an interest standpoint. So 18.6 billion, of course, was proposed, Ways and Means Committee, and of course, it is going to be part of it. We don't know what the specifics are going to look like because it's all waiting until everything lines out. One that we're going to talk a little about today is research and development. And research and development, I will tell you, is designed specifically, it shows here a negative. And that is they're making some proposals to actually take away some revenue from the Build Back America by giving more benefits for research and development, like I said, which will be our conversation a little bit further on here. So on a personal side, I'm going to slow down a little bit here and take, because this, again, a lot of our DCs out there are S corporations. What I just talked about is if you're a C corporation specifically, and then some S impact. But here's on the personal side. So a lot of concerns and cares, quite frankly, under the initial proposal of raising the ordinary income tax rate to 39.6% under Mr. Biden. Of course, House Ways and Means Committee came up with $170 billion there. But again, they're not even going to run up that poll. They're going to leave it to 37% under the House plan. This was another one that was a concern for many of my DCs out there who have investments, whether that's in the stock market or real estate, whatever the case is, was to increase the capital gains and dividend rate to whatever the ordinary income tax rate was. That was the Biden proposal, 39.6%, which is what he proposed for being the highest tax rate. That would have, again, generated about $322 billion, which B is a big number. Ways and Means Committee said, well, let's do it at 25%. But again, the House revised said, just let's leave things alone. Certainly it makes a lot of sense because right now there's a lot of still uncertainty with COVID and how that type of change would impact the growth of the markets, as well as the growth of businesses and such. Next yellow one down there, I'm not going to go through these other ones just because generally they're not going to apply. Like-kind exchange repeal. Oh, let me go back to capital gains real quickly. Another part of this here was the whole issue of when you pass away or your family or let's say your parents pass away and you inherit something. They were going to eliminate the stepped up basis, which is a huge issue, meaning that if your parents bought their house for $100,000 in 1950 and it's worth $1 million today, you'd have to pay the capital gains on from the original basis. So again, that's been struck from the proposal from the House. Like-kind exchange repeal. So this, again, a lot of my chiropractors have real estate, and they've done what they call 1031 exchanges. That was proposed to be eliminated under the Biden. Of course, that's been chopped away both on the Ways and Means as well as the House. And so as it stands right now, you can still do 1031 exchanges. We expect that's going to carry because they really thought that would hurt the real estate industry because there's a lot of buying and selling of real estate, commercial properties and rental properties through this process. And so they believe that this one here is not going to be adjusted. Now, on the SALT deduction. So this is your state and local tax deduction. As you know, under the Trump Tax Cuts and Jobs Act, they limited this to $10,000. They're wanting to modify it and raise it to $80,000. So if you live in some of these higher tax states and you have higher income, this is going to be a benefit actually. And which it's interesting. They thought that they're going to, let me say this, they believe they're still going to raise $2 billion in revenue just from doing this here. So again, I believe this will pass because there's been a lot of pushback from the states around the country who have a state income tax saying, I've got, and their position is we have residents here who are being limited. So there's been a lot of creativity of how can you get around this. And so, that's the big challenge is how to create a tool. So we expect this one here will pass as well. This one here, this next one, really created some controversy around the country. And President Biden had proposed, and even the Treasury Department, the Fed, wanted to encourage this to happen as well. And that was for $600 deposit. If you made a $600 deposit of cash into your bank account, you'd have to fill out, it'd be reported to the IRS. And which is, way beyond. I mean, right now it's $10,000. They wanted to lower it down to that $600. That was just, they felt like they were going to be able to catch a bunch of revenue that's unreported. May or may not be the case, but when you think about the nightmare, the banking industry is up in arms, of course, over this. That's been struck from this as well. I will tell you also under the tax administration, of course, Biden won $9.9 billion to go to the IRS. That Ways and Means thought 13 would be a good option, but the House has come back with 1.4 billion. What does this mean? Well, I can tell you in working with the IRS for the last 3 years during COVID, it has been a nightmare to get things through. I just read an article from the head of the IRS, and he said only 1 in 16,000 calls are answered. So, and there are about 6 million tax returns currently unprocessed right now, and generally it's about 1 million. So to kind of put things in a perspective of how far they are behind, fortunately for us, we've actually had some services that we've invested into that we can get into the IRS. It takes us, we are able to get through. That's number one thing. Number two is a lot quicker. So the good news is we're taking steps to make sure we can get the information and talk to the people up there at the IRS. Not that they necessarily have answers, but at least we can get a hold of somebody. So I hope these 2 slides here specifically have been educational, I guess would be the best way to put it, and possibly quite well. I would suggest this here, that once law is finally passed, that we just do a refresher on this here, bring you up to speed what was actually finalized by the House and the Senate and signed off by President Biden. Number one. Number two, how it's going to impact your practice. So I would say this is the initial conversation about it, and then we'll continue this process on. So many open questions right now, I would say, is number one, will the Senate agree to a bill at all? The conversations, this is an election year. We got midterm elections coming up here in about less than 10 months. And so, is there a senator or a congressperson out there, particularly the Senate, who's wanting to sign off on this here that could be the death knell to their political career? So that's a question. Secondly, if they do, how much spending can they agree to? So if the bill shrinks $500 billion to $1 trillion, what spending will be removed? Because they're putting a lot into green energy and all these type of things here, the environment. They're wanting to spend a lot for infrastructure and things such as that. If the bill shrinks $500 billion to $1 trillion, what tax increases will be removed? Because the whole idea here is if they're going to reduce the spending, they're going to reduce the taxes, in theory, of course. Can a scaled back bill still pass the House? Because as you understand, that the House has made their proposal to the Senate makes their changes, they send it back to the House. Is the House going to be okay with that? So again, this is a journey, and the saga continues. And now here's our big question. Will inflation sink the bill? I mean, they just came out, the Fed said that our inflation rate hit 7% in the month of December from year over year, 7%. And with all sincerity, if you've been to the grocery store, the gas station, and utilities and everything else, it is continually going up. So, how will this impact it? Because inflation because of course it's going to stifle potentially stifle growth. Wages are having to go up. As you as DCs understand that, you're having to spend more to hire CAs and associates. So how will that have an impact? At what point in 2022 might it become impossible? Like I said, we have midterm elections coming up in here in November. And so, how far are we going to go before they say, listen, it doesn't make sense? Because just to kind of refresh your memory, in August, they do a recess and preparing themselves to be able to go ahead and run their elections. So that's another question. And then lastly is how will Congress deal with effective dates? Now, since 1993, there's only been 2 times in history, so what's that, almost 30 years, that they've actually made it retroactive. So that's the question is, let's say, for example, if they approve it in February, March, April, are they going to make it retroactive back to January 1st? So again, that's the questions that I would propose we need to get answered. And I really don't have those answers at this time, but we expect we'll get those here in the next probably 60 to 90 days. All right. So that was the unfortunate information. I didn't have anything really solid yet for you as I was hoping to when we chose this title back in November. But I do have some good news, and that is obtaining a tax credit in 2022 is the next best thing to paying no taxes at all. Now, you may have heard me talk about this topic a little bit in previous webinars, but let me kind of drill down. I actually wrote an article for Chiro Economics that's coming out here in January that's going to be pretty much everything that I cover here. But the tax code, to keep in mind, contains over 30 non-refundable tax credits for businesses. Those are part of the general business tax credit and are claimed on Form 3800 and, of course, Schedule 3 for 1040s. The good news, as a chiropractor, you can qualify for a refundable tax credit for just doing business as usual. So I had an interesting email from one of the states that I work with, and the questions are we as a firm promoting the research and development tax credit? Are we requiring you to create a research and development department? The answer is no. And so I'm going to walk you through. So myself and my tax attorney, who actually, when under the Obama administration made this permanent, he actually sat on the committee to make this permanent, the actual research and development tax credit. What I talked about earlier in our webinar today is they've freed up an extra $4 billion that they are going to, at least what the House has proposed, an extra $4 billion to make it more expansive for research and development tax credit. So I'm going to walk you through what this looks like and why, if you've not sought this out, that may be something you may want to consider. So do you qualify for the research and development tax credit? Well, there's really only one way to determine that. There's a 4-part test to determine if you qualify. Now, so I'm going to just walk through each one of these tests. And as a DC, I can't tell you how many conversations that I've had. I mean, we'll do probably 70 events this year. And this is a common question that comes up. And that is, I'm a DC, I don't do research and development. The reality is most DCs do. And that's what I would like to walk you through, just to bring you up to speed, to educate you and your fellow DCs around the country. So the first test is called the Internal Revenue Code 174 test. So what does it say? Well, we must show that the expenditures connected to the research activities, and that's the key here, activities, were incurred in connection with the taxpayer's trade or business, which represent research and development costs in the experimental or laboratory sense. So when we think of research and development, what comes to mind generally is that you have to be writing papers, or you have to be doing something very intentional. Well, first of all, we meet the first test here because it has to be related in connection with your business. And as a chiropractor, chiropractic services is your business. So that's the number one thing here. And to drill down a little bit further, chiropractors, number one, are uncertain as to the optimal design of techniques in performing chiropractic care. And when I say this with all due respect, of course, but every patient who comes into your practice, unless you're the joint, of course, but everyone who comes into your practice is a unique situation, as you'll see here as I walk through some of these examples that my tax attorney and I put together, such as optimal method to perform decompression for a patient presenting symptoms of sciatica and who is also suffering from obesity or diabetes or geriatric patient or any number of factors. So, decompression for a lot of DCs is a valuable tool in bringing relief to pain for a patient. But there's other factors, as I just talked about here, obesity, diabetes, so on and so forth. And all those, as you know, will weigh in on your decision as far as a treatment plan. Second thing here, in addition to uncertainty with the optimal method of performing specific techniques, we've also identified that some chiropractors are uncertain as to the optimal process for treating patients, which may involve a combination of any number of different techniques which evolve over time, or what we call a custom care plan. Again, that could be laser, decompression, it could be shockwave therapy, whatever it may be. It's a multitude of things that you might do in a custom care plan. So that's section 174 test. The second one is technological factors. So the test here is the technological information test. So it requires the research be undertaken to discover information that is technological in nature. Again, you're not creating computers, you're not or software or anything such as that. But the information discovered does not need to be new to the world, only new to the individual chiropractor, meaning that this may be something that's been identified at, let's say, Palmer or Life University or just chiropractic in general. But the reality is what's new for you. So I've talked to a lot of DCs over time that have had some fresh revelation, I guess, on treatment plans. And so that's what we're really talking about here, technological information test. In practice, we've identified chiropractors undertake to discover medical information rooted in the application of biological sciences. Medical information discovered may include the optimal technique for performing spinal decompression, given the specific equipment available to a chiropractor in their office, or the optimal combination of therapies available to the chiropractor given the specific issues presented by the patient. Again, technologies come into play here. I've had DCs who have no modalities inside their practice, but because of this process here of determining the application of biological sciences does allow them to qualify at some degree. I hope this is making sense and I'm not going too fast, I hope. But again, this is going to be available. I know Chris is going to make this available, but also it'll be in Chiroeconomics here in January. Test number 3 is business processes. So business processes, or the business component test, requires that the application of the information discovered as a result of research activity is intended to be useful in the development of new or improved business component. So again, it's a trial and error. So there's trial and error that goes into play here. It's that you remove an uncertainty. So what we're coming into here is this. In practice, we found that many chiropractors are focused on improving specific chiropractic techniques, such as spinal decompression, cold laser therapy, and others. And you hear decompression quite often here because that's one that we see a lot of commonality amongst our DCs. But it could be cold laser therapy. It could be traditional laser therapy. Class 4, whatever it may be. But again, it's focusing on improving specific, the technique. So, maybe you've gone to a class through one of the decompression companies like KDT or such, and, they've presented it one way, but, in application inside your practice, you may use it in a different way. And again, I hope that makes sense to you. We've also identified that many chiropractors are focused on improving their processes, such as diagnostic processes of taking information from more and more varied sources, including digital x-rays. So if you do digital x-rays inside your practice or you have them outsourced, MRIs, orthopedic tests, myovision scans, and other sources of data. So again, bringing in that those other technology portions there or processes allows us to, again, meet this test here. All right. Number 3, a process improvement may also be the chiropractor's attempt to combine known therapies in new and unique ways. Maybe, for example, they've never treated a patient with spinal decompression along with cold laser and some specific new core exercises with their physical therapist. Or maybe you have a wellness coach inside of your chiropractic practice. So again, a multitude of things here, and that's the reason why we encourage every one of our DCs, as long as they meet the qualification I'll talk about in a little bit, at least go through that to determine if your activities are qualified. All right, experimentation. So again, this one here is a process of experimentation. This is going to be test number 4. The test requires that substantially all of your research activities must constitute elements of process of experimentation that relates to a new or improved function, performance, reliability, or quality of the business component. So when we talk at these different events, the state events and different coaching events, we talk about this here specifically, saying that the purpose of what you do is to create, improve performance and functionality. That's really what a chiropractor does, and that's what this process of experimentation is to do that. So chiropractors, most of them perform specific reevaluation. So every time I tell my DCs, every time you have a new patient comes in, you do an assessment or a reevaluation of existing patient. Here you note the results of this reevaluation with the intent to improve the efficacy of their individual techniques, or in custom care plans, they create by varying these techniques or care plans slightly over time based upon recorded patient outcomes. So again, I'll speak about my DC, who actually has qualified for these research and development credits. Every time I have a reevaluation, what he's trying to do is see how I am improving or how he needs to change up my care plan that I go and see him on a routine basis. Ultimately, the goal is to overcome uncertainty, as I mentioned before, in the chiropractic world as to the best combination of numerous chiropractic techniques available to modern chiropractors, or an optimal application of each individual therapy, such as optimal frequency to operate a cold laser based on what issues a patient presents. And so another one might be like a soft laser, would be a soft wave or a shock therapy or something like that. What settings would you use to treat this particular situation? So number 3, in so doing, chiropractors rely on the principles of biological and medical science in identifying and evaluating variations, improvements to their techniques and care plans. So again, process of experimentation, and I know I've gone really, really deep into each one of these tests today, but I want you to understand as a DC that you do qualify if, again, you meet this 4-part test, and that's why we offer what we do. So who's the ideal candidate? So I will tell you that there are DCs who do not qualify, and our process is a 3-step process. To determine whether you do. Number 1, you're going to have an initial conversation with one of my team members, and they're going to ask you some general questions about your practice. How many staff members do you have? How many CAs? How many associates? How many locations? What type of modalities? Those are the type of questions that are going to be asked of you. But we also have determined that to not waste your time in this process, we want to help give you some guidelines on why or what level it makes sense to go down this path. So the first point is that we're going to take you through an initial assessment. Secondly, is we have to collect up documentation. So that because this is a tax credit, that we have to have tax information, and we can sign an NDA or whatever it is to make you feel comfortable, or a HIPAA release about employees. But ultimately, we have to have previous tax returns, personal and corporate. And then we also have to have W-2 information, because as a DC, you're not using materials per se, as, let's say, for example, a manufacturer of some type of system. So, we have one that we've been referred over to by a friend of mine who creates computers, laptop computers, for construction and stuff. So it's very heavy duty. So, he's got parts and stuff that come into play. So again, this is not going to apply. We actually had a referral over to a dental lab in Pittsburgh who creates grills, which I didn't know was even a thing anymore, but, makes grills for people. But he uses gold. He has these gold pucks that he carries around. So again, chiropractors do not fall in that category. What it is, it's your time. Your time, your associate's time, your CA's time, your LMMT's time. Those are all the things that come into play here. It's all about the wages. How much time are you spending in the qualified research activities, what we call QRAs, determines how much percentage of your wages and your staff's wages come back to you. So as a little side note, that as you are the owner of the practice, whatever your staff has done in these capacities, whether that's a 10% level or that's a 50% level, regardless, that all flows up to you as owner of the practice. So I just wanted to make that a key point here. So it does not go to your employees, is my point. So who's the ideal candidate? Well, number 1, you need to be in business for at least 5 years. Now, the exception to that is unless you purchased a practice. And why do I say that? Well, we're actually working with some different groups around the country who help facilitate the buying and selling of chiropractic practices. So let's assume that one of these practices that you were to have purchased actually qualified for research and development. Maybe they'll work through us. And now you purchased it. As long as you pretty much replicate what they did as a DC, then that credit's going to flow over to you, and you're going to get that going forward. So it's a nice little benefit. Second thing is at a minimum of 150 patients visits per week. What we found is it used to be 100, but we realized that to be able to make it worth your time going down this process, that we actually has to be about 150 patients. And that would be actually the bottom level of that. Then we get into actually monetary minimums. You need to have as the DC at least $80,000 income. Now, the exception to this, and when I say W-2 income, the exception to this is if you are a managing DC. So let's say you've been in this industry for many, many years, and now you just pretty much have associates who treat patients, and your time doing so is much more limited. Not as a big issue on this W-2. But if you are hands-on patients all week long, then this is an important thing. You need to be making on your W-2 about $80,000. Unfortunately, I see a lot of DCs through whatever advice they've received from someone out there, an accountant, CPA, or advisor of some type, has lowered it down maybe because of college loans. But unfortunately, again, $80,000 is really the minimum. And then, of course, we can have that conversation. Does it make sense to raise? I have a former president of one of the state associations who's one of our clients. He was taking, I believe, about $35,000 as his W-2, and he had a high percentage of his time qualified for research and development. Unfortunately, he kind of hamstrung himself by having that lower W-2. So it made sense after we did our analysis for him to raise that up to be able to maximize his R&D. So, and we would do the same thing for you to see if it makes sense. And then lastly, just to kind of drill down a little bit deeper, if you have associate DCs, they need to have at least $60,000 in W-2 income. And of course, that you personally need to be paying at least $10,000 a year in federal income taxes. And why do I bring this up? It's been unbelievable that how good some DCs are about expensing everything out, where they, through whatever process they did this, they aren't paying any taxes. They're paying, $5,000 or $2,000 or no taxes at all to the federal government. Well, the problem is because the credit, you have to pay taxes to be able to be entitled to this credit. So what happens is if you don't, it's a carry forward. So what happens, you go through this process and you don't get the benefit from it, you carry it forward. Now, it would benefit you carrying forward if, again, your income, that you're paying taxes, and we can take advantage of that. But if you're going to continue that trend of not, recognizing income and paying taxes, then that, of course, becomes an issue. So we just don't want you to waste your time going through this process. This really are the four key points here. Again, is $80,000 in income for you, $60,000 for your associates. Again, LMTs and CAs, they can qualify as well, but that's not where the bulk of the credit comes from generally. And so I hope this gives some clarity. Now, very, very important. The nice thing about research and development tax credits, we can get you a refund. The likelihood is, I've owned 3 CPA firms. I can tell you most CPAs don't understand or even have a good sense of research and development. Matter of fact, I have 2 CPAs, one in Alabama, one in Florida, who have hundreds of clients that they're sending up to us because this is an area of expertise for us. We have 3 tax attorneys on our team, 6 CPAs, and we're not interested in doing your taxes. I'm just going to make it very, very clear. I meant to mention that in the beginning. The reality is we're here just to put more money in your pocket. As I always say when I speak, it's not how much you make, it's how much you keep. And that's really what we're trying to do here. But my point here is we can go back 3 years and get you a refund of what you didn't take advantage of. And then going forward is considered a credit. So we get a rebate or a refund for the last 3 years, and then going forward, you get a credit. Key point here is we have rounded into a new year. Let me take a quick drink. We're into a new year. And what a new year does, it also creates new deadlines. And what I mean by that is we can go back 3 years from the date that you signed and filed your 2018 tax returns. Meaning, if you, as an example, filed your tax return on time in 2018, some DCs do, some file extensions regardless. But if you filed it on time, April 15th for your personal, and then of course March 15th for your S corporation or your C corp or your partnership, then January 30th is our deadline, meaning for us to start this process of having a conversation, gathering up your documents, and getting you with our tax attorney's interview, which is the third point, is the third point of our process is having a conversation with my 3 tax attorneys who does a deep dive into your practice to determine what percentage of your time qualifies for R&D. So January 30th is the deadline because it takes us about 6 weeks to take you through this process. So again, we want to make sure we have enough time to meet that deadline. So if you file an extension, a rule of thumb is 45 to 60 days prior to the submission to the IRS. So if you filed, as an example, your 2018 tax returns were signed and postmarked on, or e-filed on July 15th, deadline for you would be May 15th, okay? Possibly May 30th, but I wouldn't go that much further. So we don't want you to get in a situation where you forfeit thousands, if not tens of thousands of dollars because we missed that deadline by a couple of days. And unfortunately, that does happen, and we just don't want that to happen for you. So keep in mind that deadlines are important if you don't want to forfeit your 2018. Now, 2019, 2020, and 2021, not an issue. But for us to capture that 2018, it is imperative that we know exactly, and you need to know exactly when that was filed so you don't forfeit it. All right, so bonus material. And what I mean by that is if you practice in the following states. So everything I've been talking about has been federal. So if you qualify for the federal, you'll also qualify for state R&D tax credits if you live in any of these states here. So I mean, there's some states that are very gracious and gratuitous on this, like Indiana. We have a DC up there that his state was almost equal to his federal. Wisconsin, another great state. California, well, anyways, I'm getting ahead of myself. Arizona, Idaho, California, Illinois, North Dakota, and Kansas, Rhode Island, and Maine, and Utah, and Nebraska, Connecticut, Ohio, Delaware, Texas. You know, it's interesting. Texas doesn't even have a state income tax, but they do offer an R&D tax credit for their citizens, which is cool. I'm originally from Texas, and it is a cool benefit. Indiana, like I said earlier, Vermont, South Carolina, another great state, Pennsylvania, Wisconsin, which we have a lot of DCs in Wisconsin who've taken advantage of. Virginia is another great state. Alaska, which we'll be going to this year, Christy. So again, all these are states that we will be in this year. Arizona, unfortunately, just canceled their event, but all these other ones will be at sometime this year here. So if you're in any one of these states, you don't have to wait for us to come to your conference. Matter of fact, some of you may not be part of the conference, which is a whole nother conversation. But these are states where you get the double dip, and that may be 30% of whatever the Fed does. It could be 100% of whatever the Fed does. But ultimately, this is more money in your pocket. And the other good thing is states are going to get the money out quicker than the Fed is. I just let you know that we can generally get a lot of states will disperse this in 30 to 60 days, whereas the Fed right now, because of COVID, is about 6 months. And hopefully they'll speed that thing up. And they're trying to, they just changed some new rules that when we submit an amendment, we have to, as of last week, submit all of the documentation to them, showing where our tax attorneys have determined what activities qualified. It used to be we just filed the form 6765, but now we have to give all the supporting documentation as well. Nothing that would concern you. That's more once they have reviewed it and signed off on it, it just eliminates questions in the future. So, all right, continue on here. So if you meet the minimum requirements, we have a guarantee at Quartermaster, and that is if we don't identify $10,000 in tax credits or tax savings, then I'm going to pay you $100 for your time. And the reason why we do that, because your time with your patients, and that first call is going to be about 30 to 45 minutes. And I'm sure you make a lot more than $100 an hour, but we want to take for 30 minutes. So that's $200 an hour. We just want to say thank you for going through that process. Again, you have to meet the requirements I've already laid out to you. And then, of course, regardless, if you qualify or you don't qualify, everyone who does so today or watching this video and wants to have us do an assessment will receive our Love Chiro Hate Taxes t-shirt. So if you come to one of our conferences that we're at, you, of course, can pick up one up. But if for some reason, you're not able to come or whatever, we'll actually ship this out to you. And that says Next Level. We use Next Level t-shirts, quality, high quality. We didn't want any cardboard feeling t-shirts. And so, of course, when you see us at these conferences, you're going to see our backdrop. It says Love Chiro, Hate Taxes. So we look for us wherever you may be at this year. So this is the opportunity here that if you choose to go ahead and do so and want to have the assessment done, you go to, you can scan this, you put your phone, and you just like you go to a restaurant these days, they have these QR codes. You can do that. So I'm going to leave this up for a bit. Or you can go to go.oneshub.com/CHUSA. Now, why do we do this? Because we want to know, our activities, where this information, where you actually came from as far as where you heard the information. We do the same thing with Chiro Economics and anyone else that we work with from a state level. So, and I think, Christy, you can put this in the chat box or chat line, whatever the case is, this oneshub.com.
I did. And awesome. I have a couple of questions for you.
Go right ahead, young lady.
One of our attendees wants to know if this is for S Corp only.
No, you're talking about the tax credits?
Yes.
No, it's S Corp. It's sole proprietor Schedule C. It's partnership C Corp. Every entity, however you're structured, will qualify. Oh, and that's a good point. Let me bring this up. So if you're a Schedule C, if you're a sole proprietor Schedule C or LLC filing a Schedule C, you don't have to take a W-2. It's going to be your net income, which, if you pay all your expenses, has to be at least $80,000. So good question.
Well, I'm so glad you answered that, because that was my next question. One of our attendees wants to know, why is it 150 patient visits a week?
Great question. And there is an exception to that. So 150 determines that, it's an active practice. And this is based upon an average. So I talked to a DC in a state here, I believe it was in California, actually. And I brought this up to her, and she said, well, actually, I only see about 50 to 75 a week. And I said, well, how much time do you spend with them? And she said about 30 to 45 minutes each. So that's a key. It's about time. It is your time that really comes into the factor here. So whatever percentage our tax attorney determines is utilized, that equates out to percentage of your wages. So if you're spending more time, 30, maybe 45 minutes with a patient, then of course that's the equivalent. So if she's seeing 75 and she's seeing 30 and the average DC is spending 15, that's where that would be the exception to the rule. But for 150 patients a week, and if let's say you're charging, if your average patient revenue is $50, there's got to be enough revenue that's flowing through there, assuming your expenses are average with all DCs, that there would be enough income to pay out for you as well as your staff. And like I said, there's exceptions to every rule. We just found that 150 seems to be worth your time. What we don't want you to do is walk this process and find, $2,000 in R&D tax credits for the last 3 years. Not that that's, not good money, but the reality is it's not generally, exciting for our DCs. And we want to put as much as we can. Just with all sincerity, our average is about $24,000 for going back the last 3 years. But we've had DCs get $100,000. So, for that 3-year period, just depends upon, your activity inside your practice. Great question.
Do they want to know, do you have to have any type of documentation to qualify for R&D tax credit?
Great question. Assuming that you use something like ChiroTouch or some other type of software to keep your notes, just making sure that you're doing that is a key. It was funny that this question would come up. I was talking to a DC at a coaching group that we work with, and the reality is the guy would definitely qualify based on everything he told me. And when I mentioned, he asked me that question about his side. And I said, well, yeah, there has to be documentation. He said, I don't do any. I said, well, because not to say we couldn't get him qualified, but if the IRS ever asks a question and he need to, prove it, we don't want to put him or ourselves into a position where that would be a problem. So the answer is no, we don't. When our tax attorneys walk you through the interview process, they're going to ask you a lot of specific questions. And we just tell our DCs to brag about your practice, everything that you do from soup to nuts, how much time you spend, the whole 9 yards. But they're not going to ask you for any documentation. They're going to take it by your word, but they are going to make sure that, you're doing patient notes and stuff. And, not this DC not taking patient notes. That's a whole another compliance conversation that Chris Anderson can have. And I'm sure that's a big, huge risk on his part. So
it sure is.
I won't name any names. I promise you I won't name any names.
So I guess to add to that, is there anything different they would have to do in their regular documentation then?
Great question. No, there won't. There won't absolutely be none. Like I said, our tax attorneys are going to ask specific questions about, what things new and improved or that you've done over the years, or how are you changing things? Have you added a new modality? And every year, just so you know this too, that once you get qualified, then every year, we'll have to take about 30 minutes of your time once a year with my tax attorneys to re-qualify. And that just means that just to determine if what's changed in your practice, you're going to automatically, based upon your history, qualify, assuming you do nothing new. But if you've done something new, introduced a new modality, into your practice, or changed up your techniques or your process or your care plans, then that may qualify you for more credit. I'm thinking of one particular one with another group that we work with, and he qualified for $40,000 for the last 3 years. But the way he's making changes in his practice and growing and such, his is going to continue to scale up each year. So again, every DC is like a snowflake. It's totally different. One practice is totally different than the other, all unique in their own way, like a fingerprint.
What is the tax credit amount for research and development?
So the dollar amount is, the factors are percentage of time that you as the DC, associates, CAs, LMTs, once that's determined by our tax attorney, when he does, or she, we have a female as well, does their interview with you, that is going to equate out to a percentage of your wages. And the IRS allows us to take 30% of your wages as the figure, and then whatever percentage we get from the tax attorney, let's say it's 30%, so 30% of 30% of your wages, so that'd be 24, so that'd be $7,500 if you had a 30% rate. So again, everyone's different. I've seen, the low end of probably $10,000 for 3 years going back, and then I've seen $100,000 going back, 3 years, actually $150,000 going back 3 years, and then a third of that is what you would get going forward. So whatever you qualified in the arrears for 3 years, and now you might squeeze in 4 with 2021 here, but let's assume it's 3 years, and let's say it's 24,000, then you're going to get about $8,000 going forward.
Okay. What do you charge for this service?
Great question. So if we find nothing, we charge nothing. But if we do, going into the arrears, we charge an attorney fee, which is a third. So if it's 15,000, it'd be 5,000, and you get to keep the other 10,000. So again, it's found money, and that's number one. Going forward, we drop it down to 25% because we don't generally have to file an amendment. We just get all the documentation that's required, the everything over to your current CPA or accountant, and they would just insert it into your tax return. And then, like I said, we drop it down to 25%. Now you keep 75% of whatever is found. So, good question.
Okay, let me see if there's anything else. If you have any other questions, now's the time to ask.
Like I said, I would encourage you, if you met the criteria that I laid out earlier, it doesn't hurt to walk through the process. Absolutely no charge. It's free for us to walk you through this. Like I said, if we don't find anything, I'll pay you $100 for your time. But really just determining, because again, if you don't, and let me address this here, because again, I work with CPAs all over the country. I've owned CPA firms, because a CPA doesn't understand it in their mind. What I find a lot of times when I have conversations, they have in their mind that you have to be a manufacturer of something to get R&D tax credit, and that's totally furthest from the truth. Like I said, our head attorney was on the Obama administration's team on the R&D to make it permanent. So that's number one. Number two, we actually which I thought was intriguing. I was talking with our attorneys back in December. We had our Christmas party together. We were just chit chatting. I have a DC in Minnesota who uses one of the top CPA firms in the country who actually does research and development tax credits. And they were intrigued and actually did I would say, an interview for the most part with my head tax attorney. And after they walked away, they said, absolutely, everything you just shared, they do qualify. So because again, with all sincerity, DCs are not going to be the largest tax credits, but it's, if it's $24,000, $24,000. But like that big firm, they probably wouldn't even come close to you if you didn't have $500,000 in tax credits potential, because that's just the area they work in. So we love chiropractic. I mean, we're invested into chiropractic, and our goal is to get as much money back in your pocket. So, and anything we recommend, we'll defend. So if there's ever a question on anything, our tax attorneys, our CPAs will defend the position. That's part of the reason why we sign off on the amended tax return, because who signs on it, it will come back. Now, if, let's say, for example, we send everything over to your CPA or accountant going forward and there's a question, we'll still defend it. But, if there's going to be a question, generally that would be on amendment. We've not had any audits on any of our clients, because our tax attorneys are going to go by the law. And it's generally the ones who go over that line are the ones who get the red flags and get caught. And there's companies out there that do that, and we're just not going to be one of them, because we don't want to harm our clients. We want to help our clients. So,
well, thank you so much, Don. We appreciate you being here live from Jamaica. I'm just going to keep saying that over and over again, because I'm super hopeful. I'm going to be broadcasting live from somewhere sunny soon in 2022. Just a reminder that next week we're going to be talking about the future of our workforce. If you have gone through the process of hiring in the last couple of months, you know how difficult that's been, and it appears that it may only get more difficult going forward. We have Aaron Reynolds here. He actually presented this very topic, and he's got some updates to the representatives at the Cairo Congress back in November, to our national leadership, state and national leadership and chiropractic profession. And now he's going to be sharing it with you. The following week, we have a webinar with NCMIC's Abigail Lim, and it's from slips and falls to tables and walls, business insurance for the chiropractic practice. And we're going to talk about how to make sure you're covering your assets and have everything covered. Like, we don't want you to be overinsured, but we do want you to be adequately insured in your office. And then we're going to have planning patient events with Hillary Hushhour, because, it's Valentine's Day and we want to show our love to our patients. And she's got some great ideas and basically has become the party planner person for her community. When she shares her stories, her pictures, the impact she's having on her small community, and the impact that it's having on her chiropractic office, it's so inspirational, and you're going to love it. Now, we're going to have some more webinars posted on the website soon. The following week, we're going to take a break, because right after Dr. Hillary's webinar, we're all heading to Vegas. And then we're going to take a break and then come back and jump right into it again. So if you haven't registered already, go to www.ChiroHealthUSA.com/webinars. Really, you just click the webinars tab right here. Click right there, right there. Okay, you want to go back and watch a recording, including today's. Click on Visit the Archive, and you can search. Don is a frequent guest, so you can search by his name, or you can click on, why is it not doing anything? It didn't. I don't think I'm clicking. I just think I am. You can go list chronologically, or you can view speaker, search by topic. You can just do taxes and it'll pop up, Don. So check it out. Make sure you go ahead and register for those upcoming webinars. Go back and watch them if you want to go back and listen and take more notes for today. Thank you so much for joining us today. Have a happy Tuesday, a fabulous week, and I will see you here, same time, same place next week. Bye, y'all.